Hello everybody, this is Stocker Finance with your host David Scheuer, and today I'm going to be talking about shorts versus longs and which is better. Alright, so here we have a random company called XYZ, and this is its stock graph. On the horizontal axis we have time, and on the vertical axis we have price. Although the stock may fluctuate over time, it seems to generally go up in price. So let's say that we are long on XYZ. Well, if we're long, then we generally means that we are bullish. And if we're bullish, then that means that we think the stock price will increase over time. So when you are long on a stock, you want to buy at a low price and then sell at a higher price. That way, you make the difference in price between when you bought it and when you sold it. The nice thing about going long on a stock is that the stock price can go infinitely high, so you can hypothetically make infinite gains. If the stock price were to go down, well then you can only lose as much as you bought it. So when the stock price hits zero, you will have $0 left. Alright, so let's talk about going short. If we're shorting a stock, then that generally means we're bearish. And if we're bearish, then we don't want the stock price to go up, we want it to go down. Now, let's talk about how shorting works. So first off, you borrow someone's shares of a stock. Then you sell those shares at the current market price. The goal is to rebuy the shares at a lower price and then return the shares to whom you borrowed from. That way you keep the difference and cha-ching, you profit if you did it correctly. Alright, back to the graph here. So when you short, you want to sell the stock at a higher price and then buy it back at a lower price. So you can keep the difference in the price change. The farther the stock drops, the more you profit. And if the stock price were to hit $0, then you profit 100% of the stock you borrowed. One fear when shorting a stock, however, is that a stock can go infinitely up in price. I mean, you can potentially have lose an infinite amount of money. And you'll have to pay more than what you initially borrowed that stock for when giving it back to whom you borrowed from. So, which is better? Well, let's compare the two for a second. On the long side, you can have infinite gains. You know how much you're going to lose since you can only lose as much as you put in. You're betting on the success of the company, and there's generally less risk. With shorts, you have limited gains, infinite losses, betting on the failure of the company, and there's more risk. So this may seem like I'm leaning toward the long side, but in reality, neither one is better. And there's a quick trading tip here. You can actually use both. So here's some questions I want you guys to answer in the comments below. First off, do you long or do you short more often? And the next question is, which do you think is better, long or short? I just want to know your opinion. Or is there not anyone that's better? Or are they both the same? Is shorting morally wrong? A lot of people think that shorting may be morally wrong since you're betting on the failure of the company, and when the company goes out of business, a lot of people are going to lose jobs. Whereas when you're betting on the success of a company, you're betting on people gaining more money and the company succeeding overall. So comment that down below. Thanks for watching, and go ahead and watch these videos too. Make sure to subscribe and smash that like button, and share this with your friends because this is a great way to learn about the stock market and shorting versus going long. Thank you very much. This is Stocker Finance, and I'll see you in the next video.